All right, so here we are with the income statement and balance sheet. Income statement is just the income and expenses. Balance sheet is assets and liabilities. And then this over here is actually called the statement of cash flow. So essentially, you're going to start the game by taking one of these profession cards. This one's a mechanic. And we're just going to transfer all the information over. So we'll type the profession, your name, the auditor is the person to your right, and then we'll just transfer all this information over. So right now we have a salary of $2,000. So we don't have any other income types to start the game. So all of the income types together added up equals your total income, which is $2,000. Over here we have our expenses. So we'll just transfer this over. 360, 300, 0, 60, 60, 50, and 450. And all these add up together to be 1,280. Our total income minus our total expenses is our monthly cash flow. This is what we have left at the end of each month, which is $720. This is also the number that you're going to get every time you land on or pass paycheck. We're going to write in our savings. As soon as you start the game, you're going to actually erase this number and take this in cash. And then we have our liabilities. So we've got a mortgage of $3,100. You might notice that this mortgage has an existing payment of $300 per month. Same thing with our car loan, credit card debt, and retail debt. Now, if I was to pay off this retail debt and pay off the full $1,000, I would pay $1,000 to the bank, and then I would erase my retail payment of $50. That would become zero. That would mean my expenses would go down by $50. And now when I go income minus expenses, my monthly cash flow actually goes up by $50. So I'm keeping more money every single month. So the goal of the game, of course, is to get your passive income to become greater than your expenses. One way to do that is to increase your passive income. Another way to do that, or to assist in that, is by decreasing your expenses by paying off liabilities over here. So I'm going to give you a couple of different examples of how that you would do this. So we're going to start with this card right here. So this card's a house for sale. And I'm going to show you how you would enter this. All of the different numbers on here have somewhere to go on the income statement. So we're going to start off by going down to the bottom here, and we're going to type in 3-bedroom, 2-bath, which is what it says right here, home. Our down payment is going to be $5,000, and we're going to say that I had that $5,000 cash and I paid it to the bank. Our total cost is going to be $65,000. So 3-bedroom, 2-bath house, our asset is the $5,000 down payment and the $65,000 cost. The liability is the mortgage that we owe. So we're going to write down 3-bedroom, 2-bath. And the mortgage over here is $60,000. Okay. From there, I'm going to come up to the top and I'm going to write 3-bedroom, 2-bath. And the cash flow here is $160. And so what that $160 represents, or what that means, is we've got this mortgage payment here of $60,000. Some people say, well, what about the mortgage payment? Well, what this card is saying is that we're renting this house out, and the tenants of the house are paying whatever the monthly payment is on the mortgage and all the bills. And after that, we're left with $160, meaning that the rent covers all of our expenses plus $160. So we're going to write plus $160 right here. Our total income now goes up by $160. And our monthly cash flow goes up by $160. So now every time we pass or land on paycheck, we're going to get $930. Our monthly cash flow has gone up. Our passive income is now $160. Once this number exceeds our expenses, we have finished the first part of the game. So that's the first card. I'm going to show you a second card here. And this one is Mighty for You Electronics. I'm going to show you two different things on this card. The first is how to buy a stock, and the second is how to take a loan. I mentioned earlier you can take a loan from the bank at any time. You must take loans in $1,000 increments, and your interest payment is 10% per month, which is 120% per year. So let's say I'm going to take a $1,000 loan over here. I'll put that into the bottom. My loan payment now becomes 10% of my 1,000. So for every $1,000 you borrow, it's $100 per month. My total expenses now go up, which means my monthly cash flow goes down. All right, so I've now successfully taken a loan. Now we're going to say that I'm taking that $1,000 and I'm using it to buy this stock. So the stock is MYT for you. Number of shares, well, it's $10 per share, and I've just spent $1,000. So that means I have 100 shares at $10 each. And that's it. So now these shares stay in my asset column. If I had cash, I wouldn't have had to take this loan. I would have just used cash to buy these, but we're assuming that I took money to borrow from these. Now, how do you make money from the stocks? Because it says right on the card that the ROI is 0%. And what that means is I'm not getting a monthly dividend from this. So I'm buying it low, hoping to sell it high. So let's say we're playing the game a little bit longer and another card comes up. This time it says, Mighty for You, booming market leads to record share price of this home electronics seller. Only you may buy, everyone may sell. So what that means is if I'm an owner of this stock, which I am, I can now sell it for the price of $40 per share, even if I'm not the person who pulled this card. So only the person who pulled this card can buy at 40, but anyone at the table can sell. So I'm going to say that I want to sell all of my shares. I could have sold a portion, but I'm going to sell all of them. So 100 shares at $40 each means that I get $4,000 from the bank. And the bank, I erase these shares. Essentially, the bank is buying the shares from me. And now I have $4,000. If I wanted to, I could use some of that money to pay off my loan, which would in turn erase my payment. This would go down and this would go up. Okay, so now I've got $4,000 in my pocket. How do you sell your houses? Well, your houses actually get sold through the market cards, these blue ones. So this one here says, actually, this is a bad example, but some of them will say they'll all have a different amount. So normally it would say you can sell this for $50,000. You can sell it for $100,000. So let's say a card came up and said you could sell it for $100,000. If that's the case, what I would do is I would say, yes, I'm going to sell this. And I would take $100,000 minus whatever my mortgage is. So I still owe $60,000 on the mortgage. And this number never changes. It always stays the same. We're assuming that you're paying only interest on these loans. It's not going down every month. Okay, so I would take $100,000. I would minus this $60,000, which means I would take $40,000 profit from the bank. So I'd go ahead and get that money from the bank. It also means that I need to erase everything to do with this home because I've now sold it. So I lose my $160 over here. So this 160 goes away, it's now 0. This 160 now goes away, is now 0. So this is back to 2,000. And then this goes down by 160. So it should be 670, I believe. And I've now completed that transaction. On the other hand, sometimes market cards are bad. So I could have got something like this one that says, hey, inflation goes to 10% and interest rates climb to 20%. You just lost your 3-bedroom, 2-bath house and you get nothing for it. Okay, so market cards can go either way. Sometimes they're positive, sometimes they're negative.